Assalamualaikum, my name is Mohd Asri, and for introduction, theory of consumer behavior is a way to know that the consumer wants to buy based on their preference, budget, and the utility that derive from the goods and service. For example, they can maximize their satisfaction based on their preferences. Next is for theory of economic distribution. This means income, wealth, and resources are distributed among individuals and businesses within company. This is to balance distribution of wealth, and it can reduce extreme disparities, preventing financial crisis, and fostering sustainable growth. And the objective of the assignment is to learn and understand about the theory of consumer behavior and the theory of economic distribution, so we can use this in real life and be more aware of economic and apply it practically.
Utility analysis. Utility analysis is the studies of how consumer get satisfaction from consumers' goods and service. It explains how they decide what to buy and how much to buy in order to maximize their total satisfaction given their limited resources. Total utility is the total satisfaction a consumer receives from consuming a certain quantity of good or serving during a certain period. US equal U1 plus U2 plus U3. When consumer buy several goods like X, Y, and Z, each good give a certain level of utility or satisfaction. TUN equal US equal UY plus US. Marginal utility. Marginal utility is the additional satisfaction gained from consumer one more unit of a goods or service. First one, positive marginal utility. When total utility increase, marginal utility is positive. This means the consumer is still getting satisfaction from consumer more. Second, zero marginal utility. At a certain point, additionally consumption give no extra satisfaction. Total utility stop increase. Thirdly, negative marginal utility. If consumption continue after satisfaction is reached, total utility decrease, so the marginal utility become negative.
Next, for law of diminishing marginal utility, it is a concept that tells how the satisfaction of a person consuming one more unit of a good or service. It is a concept that tells a person satisfaction level. For example, when a person drink a glass of water and they keep drinking one after another, the satisfaction level will go down. And then there are conditions known as assumptions that affect the marginal utility. For example, the first one is constant taste and preferences. The consumer preferences remain unchanged during the consumption process. And the second one, continuous consumption. There are units consumed one after another without significant time gaps. The third one is no change in incomes or prices. The consumer incomes and the price of the commodity remain constant during consumption. And then for the graph, the example is when someone drink glasses of watermelon, if they keep drinking it, the total utility or the satisfaction level will go down, and then the marginal utility will also go down when they keep drinking it, and the glasses of watermelon juice will be less, and the marginal utility will also be less.
Consumer equilibrium. A consumer is in equilibrium when they choose a combination of goods that give them the highest satisfaction within their income. This occurs when the budget line is tangent to the indifference curve. Cardinal approach. Cardinal utility theory was introduced by Alfred Marshall. It assumed that satisfaction utility can be measured in exact numbers like 4, 10, 200. The key assumption is that the marginal utility of money remains constant and consumer aim to maximize their total utility within their income limit. So, absorption of the cardinal utility for utility maximization, we have 7, which is rotationally limited resources money, maximize satisfaction, utility is cardinally measurable, diminishing marginal utility of money is constant, utility is additive. Consumer equilibrium, cardinal approach. A consumer is in the equilibrium when they maximize satisfaction by making sure the marginal utility per ringgit spent is equal across all goods. This means every last ringgit spent gives the same level of satisfaction. There are two models, one commodity and multiple commodity. We focus here on the one commodity model. So this is graph and I will explain it next slide. So MUX slope downward because each extra unit of X gives this satisfaction. The horizontal line shows constant marginal utility of money Px since MUM is constant. The equilibrium point E is where the two curves meet showing the quantity Q that maximizes consumer satisfaction. Graph explanation. The equilibrium point E1, E2 and E3 which depict point QR and X respectively derive the demand curve of goods as the point of ES. The equilibrium is at price P3 and quantity Q8. If the price decrease from PS to P2, the equilibrium equal to E2 and the quantity is going to increase. Its price increase from P1 to P2, the equilibrium equal to E1 with quantity at Q2. So for one commodity model, the consumer buy one product that seems unrealistic and it will not happen in reality because consumers are going to purchase the goods that are available in the market. So for multiply commodity model, dictator consumer behavior when multiple commodity are involved and ensure that consumers have limited resources and the utility derived from consumer goods according to diminishing marginal return. Suppose a consumer purchase two commodity X and commodity Y for the given income level and other. So for ordinate approach, the ordinate approach gives a different way of thinking about utility. Unlike the cardinal theory, it does not assume that people can measure satisfaction in number. Instead, it says that consumers can only rank their preference. A key consumers are rational and ability to rank their preference consistently. For indifferent curve is ordinary ranking of preference provide a strong theoretical foundation of analysis market demand and the law of the demand, especially through modern indifferent curve analysis. This is one reason why many economists prefer to use indifference curve analysis. Lead does not require measuring utility in exact numbers. And indifference curves show different combination of two goods that provide the same level of the satisfaction to a consumer. This means the consumer is indifferent between any of the combination on the curve. They are all equally preferred. So for absorption of the indifference curve, we have 4: ability to rank preference, test of consumer which are sensitive, diminishing marginal rate of substitution MRIs, test of consumer which are sensitive. Characteristics of indifference curve, we have 4, which is first one, indifference curve do not intersect. Indifference curves cannot cross each other. If they did, it would violate two assumptions. First, non-saturation, transitivity. The diagram shows two curves intersecting at point C, which create a contradiction and prove curve must stay separate. For the second one, higher indifference curve are preferred to lower one. Each point on a curve gives the same satisfaction utility. Higher curves represent higher utility. As consumption increase, the consumer move to a higher curve. 3. Indifferent curves are negatively sloped. They slope downward from left to right to taking more of one goods, the consumer must give up some of another. This trade-off shows the marginal rate of the substitution MAARIF. So, four indifference curves are convex to the origin. The curve bend inward toward the origin. The shape shows diminution MAARIF. The consumer has more of one goods. They are willing to give up less of the other to get even more. Consumer prefer a balanced mix of goods. For 5, indifferent curve do not touch the y-axis and x-axis. So indifferent the curve should not touch the x and y-axis because doing so means the consumer only one good, which contradict the basic assumption that an indifferent curve represents combination of two different goods that provide the same level of satisfaction. A budget line shows all the possible ways a consumer can spend their money on two goods, X and Y. It depends on Px equal price of good X, Qx equal quantity of good X, Py price of good Y, Qy quantity of good Y, i.e. income. Let's say price of good X is 5 ringgit and price of good Y is 4 ringgit. Income is 100 ringgit. If the consumer spend all the money of good Y, they can buy 25 unit of Y. How we get 25 of unit Y? 100 divide 4 ringgit and we get 25. Point A on the budget line, 0 unit of X, 25 of Y. If they spend all the money on goods X, they can buy 20 units unit of X. Point B on the budget line, 20 unit of X, 0 unit of Y. If we draw a straight line between point A and point B, we get the budget line. It show all the possible way the consumer spend 100 on goods X and goods Y. So the rule is price of X multiplies quantity of X plus price of Y multiply quantity of Y and we get total income. So change is budget. Firstly, change in consumer income. When the consumer income increase, they have more money to spend, so the budget move forward to the right. Now they can buy more of both goods. Point A move to A2 and point B move to point B2. In the income decrease, they have less money to spend. The budget line shift inward to the left. They can buy the list of both goods. Point A move to A and point B move to B1. So next, change in the price of good X. If the price of goods X goes up, the consumer can buy list of X. So the X intercept move to left and the budget line shift left. If the price of goods X goes down, the consumer can buy more of X. So the X intercept move right and the budget line shift right. In the both case, the Y intercept stay the same because the price of goods Y do not change. So for B, change in the price of good Y. If the price of good Y goes up, the consumer can buy list of Y. So the Y intercept move down and the budget line shift down. If the price of good Y goes down, the consumer can buy more of Y. So the X intercept stay the same because the price of X do not change. For the last one, both price change. When both the price of good X and goods Y change, both intersect on the X and Y axis will change as well. The direction of the shift in the budget line depends on whether the price increase or decrease. So, for combination budget line and ordinal approach, to understand how a consumer decide what to buy, we combine preference shown by indifferent curve, income and price shown by the budget line. A consumer reach equilibrium maximum satisfaction when the budget line touch is tangent to the higher indifference curve that can afford. At this point, the consumer get the most satisfaction possible with their limited income. And in the graph, point C gives the most satisfaction, highest indifference curve, but it is outside the budget. The consumer cannot afford it. Point A, B, and E are on the budget line, so they are affordable. Point A and B give less satisfaction because they are on lower indifference curve. Point E is the best choice. Is where the indifference curve just touch the budget line. At this point, the consumer get the most satisfaction possible with their budget. This is called consumer equilibrium.
In the wage, TRF, nominal wage versus real wage, and demand for labor and supply of labor in the perfect market. For nominal wage versus real wage, nominal wage is wage measured in terms of money value, while real wage refer to the purchasing power of the money received by workers. Next, in demand for labor, labor demand can be defined as demand for factor of production. Also, demand for labor can be determined by marginal revenue product. Next, the demand curve of labor is slopes downward. Lastly, in supply of labor in the perfect market, the purely of perfectly competitive market is perfectly elastic or horizontal. The number of sellers in the perfectly competitive market is large, but the size of each firm is small. No single seller can be influence the price of goods and service. Firstly, author rewards to factor of production is rent. In the David Ricardo laws, state that rent is a portion of the produce of earth which is paid to the landlord for the use of original and indestructible power of soil. Next, in the modern economy, state that land is scarce and is not in perfect elastic supply. And rent is paid because the produce of land is scarce in relation to its demand. Lastly, the in determination of rent, there are general concept of rent and economic rent. Generic general concept of rent suggests that rent and the demand for a factor of production are negatively. In economic rent, a surplus which arises due to the difference between actual earnings and transfer earnings.
So my name is ATIKAH and I will continue for this part, which is profit. So what is the definition of profit? So profit is the definition of profit is the money a business makes after accounting for all the expenses. Profit is also defined as the surplus remaining after total costs that are deducted from all the total revenue and the basis on which the tax and dividend is paid. Uh, Other than that, profit is also reflected in the reduction in liabilities, increase in asset, or increase in owner's equity. Moreover, economic profit has two relations, which is normal profit and economic profit. So how to find the amount of profit identified? So total revenue minus the total cost, and then we will get the total profit. So how about the normal profit? So the normal profit is the amount of money a business needs to make sure just to stay in the business. A normal profit is cover all the costs, include the owner's time, effort, and investment. Normal profit is also exists when the total revenue and the total cost are the same. For the economic profit is earned when the total revenue is greater than the total cost. Economic profit is also the real gain a business make after covering everything, including what the owner could have earned doing something else like opportunity cost. So now we will continue to interest. So what is the interest? Interest play the role in the capital market is to the people or organization who decided not to spend their money for personal consumption. Instead of they will use their saving money for investment purposes. Other than that, interest is the return received by the capital owner, and usually the interest is expressed in the terms of percentage and reference to as the interest rate. In addition, there are a few types of interest rates such as the nominal interest rate, real interest rate, and effective interest rate. Besides that, for the nominal interest rate is the simplest type of the interest rate. Therefore, For effective interest rate, they are very useful for lenders and investors, while for real interest rate is fairly simple but slightly more complex than nominal interest rate, and then the formula to find real interest rate is real interest rate equal to nominal interest rate minus inflation rate. Furthermore, when the highest the interest rate, so the saving will be the highest. Also, a higher interest rate will encourage people to save more of their money. Now we move to determination of interest rate. So, what is the determination of interest rate? The determination of interest rate there have been used and developed by economic is neoclassical loanable fund theory. The neoclassical loanable funds theory can be defined as the total money that people or entities that have to decide either to save the money or lend out to the borrowers that to be used as an investment rather than save it for personal consumption. Moreover, for the demand for loanable funds, it's come from the borrower side, and it has three purposes, which is the investment purposes, hoarding purposes, and consumption purposes. Also, this theory is for organizations who are seeking loans to be used for investment purposes, such as an individual may look for a loan to purchase a house or car. When the interest rate is high, the demand for investment will be low.
Hi everyone, today I will explain some policy suggestions to help improve consumer welfare and income distribution. First, the government can use something called progressive taxation. This means people who earn more money will pay a higher percentage in tax. The money collected can be used to support public service like hospitals, schools, and social aid for low-income families. Next, programmings like Universal Basic Income (UBI) or cash transfer can be given to people in need. This helps to reduce poverty and close the gap between rich and poor. For fair wages, the government should make sure workers get a minimum wage, support workers, unions, and give tax benefit to companies that pay fair salaries. In the terms of housing, the government can apply rent control and provide affordable homes, especially in big cities where the cost of living is high. Lastly, to share profits more fairly, we can have corporate tax reform and use systems like employee stocks ownership, so workers can also benefit from company profit. We can learn from countries like Sweden, which use high taxes and strong welfare to reduce inequality, and Singapore, where the CPF system helps people save money for housing, retirement, and health. That's all from me. Thank you.
So now we are at the last part, which is the conclusion. So what is the conclusion? The conclusion of our report for theory of consumer behavior and the theory of economic distribution is we need to know what the consumer wants to buy based on their needs and how they are spend their money and make a choice as a consumer. In addition, due to economic distribution, some individuals are wealthy people, while others have limits, struggle with limit means, which means because of this, they will have limit what people can buy or have it according to their ability, and it will make the economy slow down. So what the government can do? So government maybe can help by creating a fairer policy. For example, the government can include the higher taxes for the wealthy people. So because of and then this way can help a lower income group by giving them power to spend more money and make economy grow faster. At the end, a fair economy can make everyone, which is both the wealthy people and the lower income group, can enjoy, do a great choice, and everyone will be able to enjoy the benefit.